All right, good day. Today we're going to be looking at what we call investment appraisal. The topic that you are being taught is known as investment appraisal in finance and management accounting. And what we're simply trying to say here is that when it comes to the issue of investment appraisal, what we're simply trying to do is to look at series of investments readily available and make our judgment based on some various measures or benchmark. Now, what are those benchmarks? We have what we call the traditional benchmark and the discounted cash flow method of benchmark. Now, when we talk about the traditional, we're talking about those old ways by which we can base our judgment in evaluating a project if it is viable or not viable. Now, those traditional approaches like what we call the payback period is a system whereby we do not recognize the time value of money. And what we are simply concerned about is to be able to recoup our money at a stated given period of time. Now, it can be in the policy of the organization that in any project they're going to be investing in, they must be able to attain back the capital invested within a period of 3 years. So, any project that falls beyond 3 years is not viable. That is, it is not profitable, and the management may decide not to invest in such projects. And if any projects have a viability and we can invest in such projects for as long as the project meets up with the stated period of time as mentioned, as formulated in organization policy. And if the organization decides that the project should meet up 3 months or 3 years, and any project that meets up these 3 years or below automatically becomes a viable project. That's for payback period. So, and when we're talking about payback period, we're talking about the period that it will take a project to pay back its initial cost of investment. Now, so we look at the table, the year, the cash flow, and the payback itself. Now, let's look at the question in respect of Beckett's Limited. No. We were told that the initial investment on this project is £2 million, and the lifespan of the project is 7 years. And it was estimated that annual net cash inflow from the project, that is, the project will be bringing in an inflow revenue on an annual year basis of £350,000. At the end of the day, after that 7 years, or by that 7 years, if we should stop this investment or sell off this investment, we are going to be left with a residual value. What we mean by the residual value is the amount that we can recoup back in this project after or within that period of year that we have planned to undergo that project. Now, in this question, we were told in the question that £200,000 is the residual value, and the cost of capital. The cost of capital is 5%. That is the expected return. The cost of capital is the expected return by the investors. That is what the investors desire or are expecting to receive back in return from the amount they have invested. That is 5%. And in the question, we are also given the ordinal rate of 8%. That is, we have an option to choose from the cost of capital and the ordinal rate. Now, let us go deep into the question. Now, we're given the initial investment of £2 million, so that's our cash inflow. So that's our cash outflow of 2 million that we have invested in this business. So for the 0 year, we have no payback with that. So for the first year of investing, we were told that we are having an initial inflow of £350,000. Okay, so meaning that what we have invested 2 million. Now we are now what we are now recouping back 350,000 from the 2 million. Then we are left with what we have left with £1,750,000. Okay, you can see that now from what I have on the screen here. So the next one is that for the second year, we are still going to earn the same amount as net cash inflow. Okay, and this is also 350,000. So after we have earned that, we now what we deduct from the payback from the previous year of £1,650,000. We're going to have, after deducting £350,000 from £1,750,000, it means that what we have for the second year, we have £1,200,000 to recoup back from our investment. The same applies to the third year. The third year we also earned £350,000, and we have only been able to recoup up to £700,000. So we are still left with £1,200,000 to recoup. So when we now deduct £350,000 that we have earned in the third year from £1,200,000, then we're going to be left with what £950,000 as we have in the column here under payback for the third year. Now, the same thing applies to year 4. We were told in year 4 that we received a cash inflow of £350,000, and we still have £950,000 to recoup back from our initial investment. So this shows that when we now deduct the 350 from the 950, we're going to be left with what £700,000. Now the same applies to the 5th year. We earned 350,000 minus 600,000 will give us what £250,000 left. So it means that we still have £250,000 to recoup back in year 5. So in year 6, okay, in year 6, it means we have £250,000 to recoup back from 350,000. Okay, so this is an error. So that means that we have 5 years. We can recoup back the budget in 5 years plus 250,000 divided by 350,000, which will now be 5 plus 0.71 will give us 5.71 years. Meaning that within a period of up to 6 years, we can recoup back our our initial investment. Within a period of of 5 years and 5.71 years, we can recoup back our initial investment from the calculator that we have on the screen here. So that's how to prepare your payback period. And let us go deep into what we call the accounting rate of return. When we talk about the accounting rate of return, we are talking about the accounting method or methodology of preparing or appraising an investment. Now we're going to consider the initial inflows for the various years from the depreciation, which is an expense or expenses that we have incurred in the process of the investment or carrying out that business. Now, for the first year, we were told that the company earned 350,000 as cash inflow, and when we calculate our depreciation, and the formula for depreciation is the cost or the market value of the item or the initial investment cost minus the residual value or scrap value in other case, which is the amount that we are going to recoup at the end of the life of that asset over the lifespan. That is the number of years that investment, it will take that investment to mature, and for us to stop that investment. So that's what we have £200,000 as a cost minus what's our residual value from the question. It was given as £200,000 divided by Divided by 7 years. The 7 years is the lifespan of the investment. Okay, so it will give us It will give us 257,143. That is 257,143 will be Will be the depreciation. 253. So let me type that here. 253,147. 253,147 pounds. So what we're now going to do is that for us to be able to get the accounting rate of return, we're going to deduct the depreciation value from the cash flow. That is the cash that flows into the business. We're going to deduct that from it. At the end of the day, we're going to be left with a profit of £92,857. Okay, on a yearly basis. Now this shows that if we are to apply the accounting rate of return, okay, we can make a profit of 650,000. We can make a profit of what? 650,000 at the end of the 7th year. Now, for us to now calculate the accounting rate of return, we have to determine the average accounting profit, which is what? This 650,000 naira that we, 650,000 pounds that we have here, divided by 7 years. That is the average. It means on the average, the business will earn a profit of 92,858 pounds, 92,858 pounds on an annual basis. Okay. Now, for us to be able to calculate the ARR, which is the accounting rate of return, though there are various formulas, we have the profit over total investment times 100. Profit over total investment times 100, or the average profit over the average total investment multiplied by 100. Again, the average profit over total investment times 100, or the average profit over the average investment. Okay, we should be considering the initial investment and the residual value of the investment. Okay, and we find the average. Now, for this case, we have what? The average profit as 90,858 pounds over 2 million pounds multiplied by 100. This will give us 4.64%. So I'll stop on this note and I'll continue the next lecture in the next video. Thank you and God bless.